Welcome to This Explainer. Look, if you're here, you already know that investing is about so much more than just watching ticker symbols flash red and green on a screen. Today, I want you to step into the role of a financial detective. We're going to embark on a really systematic, diagnostic breakdown of a company to discover its true fundamental value. We're looking straight past all the noise, past the hype, and right into the financial DNA of the business to measure its actual profitability and uncover its hidden risks. To set the stage for our investigation, let's start with this brilliant thought from Oscar Wilde. He said, "A cynic is one who knows the price of everything but the value of nothing." It's a powerful philosophical hook, isn't it? I mean, in the financial markets, it is remarkably easy to find out the price of an asset. You literally just look it up. But a fundamental postulate of sound investing is that an asset's price rarely equals its true value. Our whole job is to bridge that gap. We don't want to play the bigger fool game, just crossing our fingers and hoping someone else will pay more later. We want to ground our investments in absolute reality, backed up by the cash flows a company is actually expected to generate. All right, so here's our mental roadmap for this explainer. Think of the company we're analyzing as a patient, and these four areas are basically its vital signs. First, the core financial statements. Second, gauging company profitability. Third, measuring financial risk. And finally, adjusting accounting earnings.
Section 1, the core financial statements. Okay, let's dive right into this anatomical foundation of a business. There is a really critical contrast between our two most important financial statements here. On the left, we've got the balance sheet. I want you to think of this as a photograph. It's a static snapshot taken at a single exact point in time, say exactly at midnight on December 31st. It tells us what the firm owns, which are its assets, and exactly how it paid for them through liabilities and equity. Now, over on the right, we have the income statement. If the balance sheet is a photograph, the income statement is definitely a video. It tracks the flow of revenues and expenses over a specific period, like a quarter or a full year, showing us how the company actually performed during that stretch of time.
Now, to truly read that video of the income statement, you have to understand the underlying logic making it work, which is accrual accounting. Accrual accounting means recognizing revenue when a good is sold or service is performed, and then, and this is absolutely crucial, matching the corresponding expenses to that exact same period. This all happens regardless of when the physical cash actually changes hands. Think of it kind of like running a tab at a bar. When the bartender hands you a drink, a transaction has occurred, and revenue is recognized right then and there, even though you aren't going to hand over your credit card until the end of the night. You're matching the effort to the revenue generated, not the physical cash in your hand. This matching principle is exactly what allows us to see if the core operations of a business are actually sustainable over time.
Moving on to Section 2, gauging company profitability. Time to check the pulse and see how effectively a firm actually generates returns on the investments it makes.
You know, it's remarkably easy for financial jargon to just blur together, but what's really interesting about this slide is how it cleanly separates these three vital formulas. We need to keep them distinct because each one answers a totally different question about profitability. Return on assets, or ROA, measures raw operating efficiency prior to the effects of how the company is financed. Return on capital, or ROC, looks at the profitability of the overall firm by comparing operating income to the total capital invested, so that's debt and equity combined. And finally, return on equity, or ROE, zeroes in strictly on the profitability from the perspective of the shareholders, comparing net income to just the equity portion of the business.
Let's look a little closer at return on capital, or ROC. You'll notice the numerator up top is EBIT. That's earnings before interest and taxes, multiplied by 1 minus the tax rate. Essentially, this is just the after-tax operating income. The denominator is the book value of capital. By actively separating the financing effects, like interest payments, away from the operating effects, ROC gives us a much cleaner, truer measure of the return the firm is actually generating on its invested capital. It strips away all the noise of how the company chose to fund itself, allowing us to see the pure quality of the business engine.
Let's just pause for a second here. Why does this matter to you as an investor? Well, it's super easy to get lost in all that algebra, but I want to explicitly remind you, these dense formulas aren't just math. They are vital clues. They are the diagnostic tools that reveal the true underlying quality of a company's investments. A company can show massive revenue growth, sure, but if its return on capital is consistently lower than what it costs to borrow that capital, the company is effectively destroying value with every single sale. These metrics tell you if the engine is actually generating power or if it's just burning through fuel. Section 3, measuring financial risk. Generating returns is only half the story, right? We now have to pivot to the cholesterol of our diagnostic approach. We have to analyze the financial risk,
because danger inherently comes with opportunity.
To measure risk properly, we literally have to recognize a massive philosophical divide between how an accountant sees the world and how an investor must see the world. An accountant generally tends to look backward. Their view of risk is static and default focused. They're sitting there asking, at this exact moment in time, does the firm have the capacity to meet its fixed obligations, like paying off a loan? The investor, however, must be forward-looking. An investor's view of risk is all about variance in expected returns, the pure unpredictability of the future. The investor has to focus on equity risk and non-diversifiable market risk. Now, the accountant's toolkit for measuring risk usually involves combing through the footnotes for contingent liabilities, things like a pending lawsuit. They also look at short-term liquidity risk using tools like the current ratio to ensure bills can be paid next month. And they check long-term default risk through debt-to-equity ratios. These are incredibly important for predicting bankruptcy, for sure. So the crucial point is this. An all-equity-financed tech startup with zero debt might look incredibly safe to an accountant simply because it has no fixed loan obligations. But to an investor, that exact same firm is highly risky because its future earnings are wildly unpredictable. You really have to use the accountant's data but view it entirely through the investor's lens. Section 4. Adjusting accounting earnings. Let's move on and see how all this builds into a reality check. Because the truth is, reported GAAP earnings, even when audited perfectly, can sometimes be deeply misleading for an investor who's trying to find fundamental value. Standard accounting rules often miscategorize critical expenses. The absolute biggest offender here is research and development. Accountants treat internal R&D as a current operating expense, subtracting it entirely from the current year's profits. But think about it. If a company is spending billions on a patent that will generate revenues for the next 10 years, that isn't a current expense. It is a long-term capital investment. This accounting quirk unjustly penalizes innovative growth companies, making them look way less profitable than they really are. So, as financial detectives, we fix this in 3 actionable steps. First, we identify that R&D operating expense. Second, we manually recategorize it as a capital expense. And third, we amortize it, meaning we spread that cost out over its actual useful life. When you do that, suddenly the true profitability of a growth company becomes crystal clear. Another massive distortion comes from operating leases, like a retailer signing a 10-year lease for a storefront. Traditionally, accountants just treat these lease payments as simple operating expenses, but a multi-year lease is a firm, non-cancelable commitment to pay money in the future. That is literally the exact definition of debt. Operating leases hide massive amounts of debt completely off the balance sheet. And this brilliantly illustrates why investors must manually adjust earnings to see the whole picture. We must identify those operating leases, capitalize them as true financing expenses, and then add that hidden debt back onto the firm's liabilities. That is how you see the complete, unvarnished picture of their actual financial risk. When you finally understand accrual accounting, when you can cleanly calculate return on invested capital, and when you know exactly how to adjust for the accountant's blind spots regarding R&D and hidden debt, you cease being a spectator in the markets. You become an evaluator. I want you to look at your own portfolio today, apply this diagnostic toolkit we've talked about, and ask yourself this final provocative question. When you buy a stock, are you just paying for the price, or are you truly investing in the value? Thank you so much for joining me on this explainer. Keep digging into those financial statements, and I will see you next time.